If you look at the headlines, Nvidia is either in the biggest AI bubble of all time, or it's the most important company of this decade. But here's what almost nobody tells you. Nvidia now makes over $50 billion per quarter from data centers alone. Demand for its AI chips is estimated to be 12 times higher than supply, and somehow, its valuation is lower than some boring retailers like Costco. So in this video, I'm going to cut through the hype and show you what's actually true about Nvidia right now, and whether that makes the stock a buy on dips, a hold, or something you should be very careful with. Here's what we're going to answer today. Is Nvidia's AI demand actually real, or just marketing? How serious is the threat from Google, AMD, and Chinese AI chips? And based on the numbers we have today, is Nvidia still a core AI holding, or is it time to take profits? Let's start with the only place everyone should start, the hard numbers. Before we talk opinions, let's talk facts. In its latest reported quarter, Nvidia delivered roughly $57 billion in total revenue, around $51 billion from data centers alone, and that data center number grew about 2/3 year over year and more than 20% quarter over quarter. So this isn't a maybe one day AI will pay off story anymore. Nvidia is already an AI cash machine, and almost all of its growth is coming from one place: selling infrastructure for AI, GPUs, networking, and software for massive data centers. This is important. We're not talking about a meme stock. We're talking about a company printing tens of billions per quarter today. Now, the big emotional question: is Nvidia crazy overvalued? When people hear AI stock, they think bubble, FOMO, collapse. But look at this. Nvidia trades around the high 20s to low 30s forward PE. Walmart trades in the mid 30s. Costco trades close to 50 times forward earnings. So you have a grocery and warehouse business growing high single digits at 45, 50 times earnings, and the center of the AI infrastructure boom at roughly 30 times earnings. Is Nvidia cheap? No. But can we honestly call it the biggest bubble in the market, while Costco sits at a higher multiple with far slower growth? That doesn't really hold up. A more intelligent way to say it is, Nvidia is priced like a dominant growth company, not like a lottery ticket. The real risk is not just the PE number. The real risk is whether this AI demand actually keeps going. This is where Nvidia's story gets extreme. Analysts who track the AI chip supply chain estimate that demand for Nvidia's AI GPUs is roughly 12 times higher than supply. For every one GPU Nvidia can ship, customers want about 12. That's why Meta still can't get all the GPUs it wants. Cloud providers complain about allocation, not pricing, and Nvidia's AI chips are described as effectively sold out into 2026. That kind of imbalance gives Nvidia huge pricing power. If 10 customers are fighting over one rack of GPUs, Nvidia does not have to discount. They can bundle networking, software, and support, and still have a waiting list. That's how a hardware company ends up with software-like margins. So is this just hype from one analyst? Look at the market share. Most estimates put Nvidia at 80 to 90% of the AI accelerator market. That's not just because their chips are fast. It's because they own the full stack: the GPUs, the CUDA software ecosystem, the libraries and tools that developers already know. For a lot of enterprises and startups, switching away from Nvidia isn't just a hardware decision. It's a decision to retrain teams, rewrite code, and rebuild systems. That's why you keep hearing this phrase. It's Nvidia's world. Everyone else is paying rent. It doesn't mean Nvidia has zero competition, but it does mean that right now, it's still the default platform for AI. Now let's be fair. Nvidia is not alone forever. Google TPUs are very real. They're optimized for specific machine learning workloads. They're powerful inside Google's own cloud, and Google is increasingly offering them to third-party customers. AMD is also real competition. Some cloud providers will use AMD to diversify away from Nvidia. AMD can be more attractive on cost for certain deployments. And big tech will keep building their own custom chips. So is Nvidia doomed? Not today. Most of these alternatives are narrower and less flexible than Nvidia's general-purpose GPUs plus CUDA ecosystem. The honest takeaway for investors is competition is rising. It will limit how extreme Nvidia's pricing can get and slowly take share in some use cases. But right now, Nvidia still owns most of the market and, more importantly, owns the ecosystem. The market is not pricing no competition. It's pricing a very strong leader that will gradually face more pressure. Now let's zoom out. In the CNBC clips, you heard a lot about the Fed, quantitative tightening, QT is ending. The market expects a rate-cutting cycle over the next couple of years. Why does that matter for Nvidia? Because Nvidia is a long-duration growth stock. Most of its value comes from future cash flows in 2026, 2027, and beyond. When rates fall and liquidity improves, investors are more willing to pay for those future earnings. That's why AI and tech high flyers sold off harder when markets suddenly believed the Fed might not cut. It wasn't because Nvidia's business broke. It was because leverage and positioning unwound. So the macro takeaway is, if you believe we're shifting from tightening to easing, that macro environment historically supports exactly the type of stock Nvidia is. It doesn't guarantee gains, but it's an important tailwind to understand. We also need to talk about the biggest geopolitical risk, China. The US has tightened export controls on Nvidia's highest-end AI chips. Certain GPUs simply cannot be sold to China anymore. Nvidia responded by designing downgraded versions for that market, but even those are constantly under review. At the same time, China is investing heavily in domestic AI chips to reduce dependence on US technology. So how does Nvidia handle this? Jensen Huang and the company essentially use a zero China baseline for their strategy. That means they assume no meaningful high-end China revenue as a base case. Any future sales into China are treated as upside, not the core foundation. This is a smart way to de-risk the story. For investors, the truth is, export controls are a real headwind, and they will accelerate Chinese competitors. But Nvidia's current growth does not depend on China being wide open. It's a drag on the upside, not a fatal flaw in the business. Now here's where a lot of people get shaken out. Nvidia is extremely volatile. When the Fed narrative shifts, or when any AI headline hits, Nvidia can drop 10, 15, even 20% much faster than the S&P 500. But that volatility often says more about positioning and leverage than about Nvidia's actual earnings. Recently, AI high flyers fell much more than the market at the same time Nvidia was reporting huge revenue and profit growth. So as an investor, you have to separate price volatility from business fundamentals. If you can't handle big drawdowns, Nvidia will always feel uninvestable. If you can, volatility is often where the opportunity hides. So, with all of that, what do we actually do with Nvidia? Here's the balanced picture. In Nvidia's favor, massive current AI revenue, tens of billions per quarter. Demand still far above supply, giving pricing power. 80 to 90% share in AI accelerators plus a sticky software ecosystem. A macro setup that increasingly favors growth names again. Real risks. The multiple can compress even if earnings grow, especially if AI enthusiasm cools or growth slows. Competition from Google, AMD, and Chinese chips will gradually increase. Policy and export risks will keep adding headline volatility. So here's how I would think about it. If you believe the AI CAPEX cycle has at least another 3 to 5 strong years ahead, Nvidia still makes sense as a core AI holding you ad on big pullbacks. If you think AI spending is a 1 or 2 year fad, then no matter how good the last quarter looks, Nvidia will always feel too expensive for you. The stock is no longer a secret, but the execution and the moat are still very real. So now I want to hear from you. Do you see Nvidia as the toll booth of the AI revolution, or as a crowded trade that will blow up when the next shiny AI name shows up? Drop a comment. Are you buying, holding, or taking profits on Nvidia right now? And why? If you found this breakdown helpful and you want more deep dives with real numbers, not just hype, hit like, subscribe, and check the other videos on CoreWeave, Nebius, and the rest of the AI infrastructure stack on this channel. Because Nvidia might be the king of AI chips, but the real opportunity could also be in the companies building the roads, the clusters, and the shovels around it.